Hey guys, today we're going to analyze Zomato, which is one of India's leading food tech and delivery platforms, which is known for redefining the way we order food, shop for groceries, and even source restaurant supplies. And now, what makes Zomato worth discussing right now? For the first time in its history, Zomato has turned profitable, posting a net profit of 351 crores in FY24. And this is a massive turnaround from a loss of 971 crores just a year ago, marking a major milestone for the company and its investors. And at the time of recording this video, Zomato stock is trading at 227 rupees, which represents a massive 21% drop from its peak in the last 30 days. However, over the past 5 years, the stock has delivered an impressive 80.28% return, highlighting its long-term growth potential despite short-term fluctuations. And if you're new here, this is Pradeep. I work 9 to 5 as a senior product manager and have managed to grow my wealth through smart investments on the side. And on this channel, I break down complex finance stuff into simple and actionable steps. And if you want to do the same, subscribe and follow along. Now coming back to this video, we'll be covering how Zomato makes money, what makes it stand out from the competition, and its key financial numbers you need to know, and whether it's worth investing in Zomato stock in 2025 or not. Now let's dive in. This video is for educational purposes only, and always do your own research or consult a financial advisor before making any investment decision. Starting with the business side of things, Zomato started as a restaurant discovery platform but has grown into a full-fledged online services ecosystem. And today, the company operates in 4 main verticals. Number 1, food delivery. Zomato connects millions of customers with over 2.47 lakh active restaurants and a fleet of 4 lakh delivery partners handling food orders with a gross order value of 32,224 crores in FY24 alone. And coming to the second model, it's quick commerce. And through Blinkit, Zomato delivers groceries and essentials in just under 15 minutes. And this segment reported 12,469 crores in gross order value, growing by 93% year on year. And coming to the third model, which is their B2B supplies through Hyperpure. Zomato also helps restaurants source fresh, high quality ingredients directly from farmers and producers. And Hyperpure's revenue grew 111% year on year to 3,172 crores in FY24. And coming to the fourth one, it's their going out model. This includes event ticketing and dining reservations with a gross order value of 3,225 crores, growing to 136% year on year in FY24 alone. And now Zomato's ability to operate across these segments positions it as a one-stop solution for food and leisure related needs, making it a leader in the online services industry. And talking about its business model, let's take a closer look at how Zomato makes its money. Number 1, food delivery. Now this remains Zomato's main business, and the company earns commissions from restaurants and delivery fees from customers. And with over 1.6 million orders delivered daily, the sheer scale of operations is what drives its steady income in the segment. And coming to the second model, as we discussed earlier, it's quick commerce through Blinkit. Now Zomato's grocery delivery service has been growing fast, and it currently operates 526 stores across India, and the company is planning to expand this to 1,000 stores by FY25. Now this investment shows how serious Zomato is in being a big player in this market. Now coming to its income from Hyperpure, Zomato helps restaurants get fresh, high-quality ingredients through its B2B service, which is Hyperpure, as we discussed earlier. And in FY24, the platform supplied over 10,000 metric tons of ingredients every month, helping thousands of restaurants run smoothly. Now coming to their fourth revenue model, which is through their going out section. This is a smaller but growing part of Zomato's business. They make money by helping people book dining experiences and event tickets. And it's an interesting add-on to their food-related ecosystem, giving them another way to stay relevant to their customers. Now let's talk about their ecosystem and operations. So Zomato operates a robust tech platform that connects millions of customers with restaurants and delivery partners seamlessly. The acquisition of Blinkit has added depth to its ecosystem, allowing Zomato to cater to multiple customer needs beyond food delivery. And in FY24, Zomato's platform processed over 580 million orders across all segments, reflecting its ability to handle massive scale efficiently. Moreover, the company's tech investments in AI-powered logistics and customer experience enhancements ensure smooth operations and faster deliveries. Now talking about its scalability, Zomato's 12,241 crore cash reserve provides the financial strength to fuel its growth ambitions. Whether it's expanding Blinkit's store network or scaling Hyperpure supply chain or even entering new markets, their strong cash position allows Zomato to invest aggressively while staying resilient in a competitive landscape. Now coming to the most interesting part, which is Zomato versus Swiggy. Let's dive into a comparison of India's food delivery chains. And Zomato, which currently commands a market cap of over 2,05,000 crore rupees, has shown promising signs with a positive EBITDA of 889 crore rupees and an earnings per share of 0.41 rupees. Now, their return on equity, which is ROE, stands at 1.76%, and they've maintained a remarkably low debt to equity ratio of just 0.037, showing strong financial discipline in their operation. In contrast, Swiggy, valued at 1,03,000 crore rupees, is still navigating through its growth phase with negative EBITDA of minus 1,858 crore rupees. And while they're carrying a slightly higher debt to equity ratio of 0.11, it's worth noting that both companies operate with relatively low debt levels compared to traditional businesses. And the key difference lies in their profitability metrics. While Zomato has achieved positive returns, Swiggy is still focusing on market expansion and customer acquisition, as reflected in the negative return on equity of minus 27.9%. Now, both companies are investing heavily in technology and market expansion, but Zomato appears to have found a better balance between growth and profitability at this stage. And now, talking about their growth story, Zomato operates in an industry with immense growth potential, and the Indian food delivery market alone is expected to grow at a 12% CAGR over the next 5 years, while quick commerce is growing even faster at nearly 25% CAGR. And Zomato's focus on expanding into quick commerce and B2B supplies has been a major factor in its growth story. Blinkit, their quick commerce platform, has already added 526 active stores across India, and they have ambitious plans to scale this up to 1,000 stores by FY25, as I've already mentioned. Now, on the B2B side, Hyperpure has been growing steadily as well, and to support this growth, Zomato has already expanded its warehouse capacity to 0.7 million square feet, ensuring it can handle the increasing demand from restaurants for fresh and high quality ingredients. And Zomato's innovative roadmap includes enhanced AI-powered logistics and personalized customer experiences, ensuring it stays ahead of the competition. Now, let's talk about something very interesting and important, which is their numbers. Number 1, revenue and profitability. Zomato reported revenues of 12,961 crores in FY24, growing by 71% year on year, and for the first time the company turned profitable with a net profit of 351 crores compared to a loss of 971 crores in FY23. Now, number 2, operational metrics. When it comes to operational performance, Zomato has made significant progress, and one key measure of profitability, which is their EBITDA that shows how much the company earns from its core operations, improved to 372 crores in FY24. Now, this is a huge turnaround from a loss of 783 crores in FY23. Now, additionally, Zomato's cash flow from operations turned positive for the first time, reaching 646 crores in FY24. Now, this shows that the company is now generating enough cash from its day-to-day business to fund its operations, which is a critical milestone for long-term sustainability. Now, coming to its valuation metrics, Zomato's PE ratio stands at 586x, which is high but typical for growth companies. Now, competitors in the online services industry like Swiggy and Policy Bazaar, making Zomato's profitability a key differentiator. Now, let's look at the peer comparison. If you compare Zomato with some of its key competitors in the online services industry, Zomato stands out with a market cap of 2.05 lakh crore, making it the leader in its space. And its closest competitor, Swiggy, follows at 1.03 lakh crore, showcasing the significant gap between the two. When it comes to revenue growth, Zomato is leading the pack with a remarkable 71% year on year. And this impressive performance not only highlights its strong market position, but also shows how Zomato is growing faster than most of its competitors in the industry. So let's talk about the risk factors. Like every investment, Zomato isn't without its risks, and here are a few things you should consider. Number 1, intense competition. Swiggy still remains a strong rival in food delivery, and Dunzo is giving Blinkit a tough fight in quick commerce section. Now, staying competitive will require significant investments. Now, coming to number 2, high valuation. A PE ratio of 586x means Zomato's stock is expensive, and if the company doesn't deliver consistent growth, the stock price could correct sharply. And number 3, urban dependency. Zomato's growth is heavily reliant on Tier 1 and Tier 2 cities. Expanding into smaller towns may be challenging due to lower order volumes and profitability. Number 4, regulatory risks. Any changes in government policies around food safety or delivery practices could impact their margins. Now, after discussing all of this, is Zomato worth investing in? Here's the bottom line. Zomato's impressive revenue growth and its first ever net profit of 351 crores in FY24 highlight the company's strong growth potential, and its diversified business model covering food delivery, quick commerce and restaurant supplies positions it well for long-term success. But that said, the stock's high valuation means it's better suited for investors with a higher risk appetite who believe in India's digital growth story. For those who prefer stability, waiting for a correction or more consistent earnings might be a better option. And now tell me, what's your take on Zomato's future? Let me know in the comments below. And don't forget to like, share and subscribe for more insights on stock market. And thanks for watching, and I'll see you in the next one.